Hello, everyone, and welcome back to the Peterson Institute for International Economics. I'm Adam Posen, the Institute's president, and we are very glad to be running the latest of our semi-annual Global Economic Prospects events, which we hold the week before the IMF World Economic Outlook. And this event and this process that we run is led by our colleague, Karen Dynan. Today, we're fortunate to have with us, along with Karen, our Reginald Jones Senior Fellow, Chad Bown, who is going to talk about supply chains and inflation, and our colleague, our newest colleague, non-resident Senior Fellow, Stephen Freeze, also at Oxford, to talk about energy and inflation. I will give them a more proper introduction in a moment. Just two reminders. First, we have been running semi-annual global economic prospects for nearly 20 years now, and we view ourselves as obviously not the IMF or the OECD in terms of large team forecasts or investment banks with their day-to-day data monitoring. What we have done under Karen's leadership is have a group conversation and try to identify ways we think the consensus and the latest official sector forecasts may have missed the point or may have missed a point. We're not trying to be backseat drivers. We're putting ourselves out there ahead of time to say where we think things are. And because of our independence, we are able to flag some things that politically or institutionally are blinded sometimes, or just simply we have different analysis. Sometimes, of course, we are wrong, but we hope that's relatively rare, and we hope it's always interesting and responsible. And I know with today's colleagues, confronting the downgrades we're having in growth and the upgrades we're having in inflation forecasts, it will be interesting and responsible and relevant. My second announcement is just to remind everyone, particularly our core audience of stakeholders who are watching this either as registered guests or live around the world on YouTube or in recording, that next week we'll be having the second edition of PIIE Macro Week. The idea is now we're going to be accompanying in the spring meetings every year, we hope, with a stellar cast of international officials to talk about the macroeconomic issues of the day. And the global economic prospects, from our point of view, is the gateway into not just our macro week, but the spring meetings. And this year, we're having in person, because of the recovery of the world, or at least the advanced economies from COVID, a spectacular array of speakers. If I can share my screen. So PIIE Macro Week will include the people so memorably pictured here. We will be starting on Monday with Lawrence Wong, Minister of Finance of Singapore, and Wally Adeyemo, the Deputy Secretary of the US Treasury. And they will, of course, be talking not just about macroeconomics, but sanctions and the financial world. On April 19th, we have two of the most thoughtful officials in international economics, Thomas Jordan, chairman of the Swiss National Bank, and Nadia Calvino, vice president and minister for the economy of Spain, but importantly also the International Monetary and Financial Committee chair. On Wednesday, April 20th, Charles Evans, Federal Reserve Bank of Chicago president, I think one of the leading thinkers on the FOMC, will be talking to us about the US and inflation outlook. On April 21st, we are very proud to welcome back Paolo Gentiloni, the European Commissioner for the Economy, where we have much to hear about what's happening in Europe on fiscal and joint policy, and Andrew Bailey, Governor of the Bank of England, who of course is facing the same issues as the other central banks and in a unique fashion. And finally, to close out Macro Week, we are delighted to welcome back to the Peterson Institute podium Christine Lagarde, President of the European Central Bank. We're pretty much full up in terms of our limited seating for these live events, but you can check, and certainly please mark your calendars for this discussion. So with that, let me now turn to today's discussion, which again is about why and how we are downgrading our growth forecast and upgrading or rising our inflation forecast. Those directional calls are, of course, common to any reasonable forecaster right now. What's more important is the logic and rationale behind them. And that's what I'm going to call on my colleagues to explain. And importantly today, I think we're doing a great job of integrating the macroeconomic with the microstructural in the form of Stephen and Chad on their issues. So again, not to gild the lily, but let me properly introduce Karen Dynan, who is non-resident senior fellow at the Peterson Institute, but also professor of the practice at Harvard University's Economics Department. She served as Assistant Secretary for Economic Policy and Chief Economist of the U.S. Department of the Treasury from 2014 to 2017. And from 2009 to 13, she was Vice President and Co-Director of Economic Studies at Brookings, our neighbors across the street. Previously, she was a leading economist at the Federal Reserve Board and served major work on macroeconomic forecasting and household finances. Chad Bown is the Reginald Jones Senior Fellow at the Peterson Institute and has been with us since 2016. I'm proud to say he's previously been a senior economist at the Council of Economic Advisors at the White House, as well as at the World Bank and the World Trade Organization. Many of you know Chad from his various trackers done in collaboration with the Peterson Institute communications team, now on sanctions, as well as previously on US-China trade. But of course, Chad is also an incredibly distinguished researcher, one of the few economists working successfully on international law issues and international trade, as well as straight economics. Finally, let me reintroduce and re-welcome our colleague, Stephen Fries, who is the non-resident senior fellow since just this March, last month officially, but he's also a senior associate fellow at the Institute for New Economic Thinking at the University of Oxford. Previously, Stephen was chief economist at Shell and at the UK Department of Energy and Climate Change, or what used to be called the UK Department of Energy and Climate Change. As many of you saw at the release meeting we held for his new book, Transforming Energy Systems, earlier this year, his current research focuses on the economics of transforming energy systems, energy reforms to accelerate change, and issues of sustainable finance. He has already contributed to the economic analysis when he was in government that underpinned some major energy and climate reforms in the UK and that helped pivot Shell's strategy towards low carbon alternatives. So I'm very proud to be introducing these colleagues, and I will now shut up and allow Karen to give us the global and US outlook.
Thank you for that introduction, Adam. I am going to share some slides. Okay, so let me just get things positioned. Yeah, so thank you for the introduction. It's wonderful to have an opportunity to present my outlook again. As you can see on this slide, the key themes of my outlook are high inflation and slowing growth. So inflation is really the star of the show. It has climbed sharply in most economies, as I think everyone knows. This slide shows you the figures for a bunch of advanced economies. The graph doesn't have this morning's data point for the US CPI on it. If it did, you would see the black line going up to 8.5%. But in any event, we are seeing higher inflation in all types of economies, not just the advanced economies. And this has profound implications for the global economic outlook, most importantly, because it increases the imperative to remove monetary policy support. So as a result, I'm forecasting global growth to step down markedly from a 5.8% increase in 2021 to a 3.3% rate of increase in 2022 and 2023. And in fact, if you look at the quarterly data, growth has already slowed on a quarterly basis. Before I get to the individual country forecasts, let me say that there is a set of common factors that are bearing on the outlook for most countries. So in many cases, there's underlying momentum in demand for goods and services that has to do with the buildup of pent-up demand during the pandemic and the accumulation of savings that can finance such demand. And I'll talk more about that when I get to the US outlook. On the other hand, there have been and will be setbacks from episodes of resurging COVID, Disruption from the war in Ukraine, including higher prices for energy, food, and other commodities, are weighing on economic conditions around the world. And many countries are experiencing the highest inflation in decades, which is necessitating a rapid transition from monetary policy support to neutral policy or beyond. Now, turning to the large advanced economies, it's really only the United States that has entirely recovered from its pandemic downturn, which leaves scope for further cyclical rebound in the other economies that you might expect to boost their growth this year. But that's not the case. I am projecting growth across the board that will deliver only moderate further recovery because of the dampening factors that I just discussed. Beyond that, Europe is struggling, particularly with energy issues related to the war in Ukraine that Stephen will discuss in a minute. Growth in Japan is being damped by higher imported input prices and the COVID situation, which is a bit better, but still an issue for them. And incoming data is showing a sharp stalling in the United Kingdom. Now, turning to the large emerging economies, the stories and projections are more divergent than they are for the advanced economies. I mean, to be sure, the common factors that I mentioned before are relevant for all of them, but some of these economies have additional factors that are weighing on their outlook. So China is likely to have subdued growth by China standards. Activity this winter and spring has been quite disrupted by COVID surges. And even once the COVID situation, if it does get behind them, the property sector slump is going to weigh significantly on growth. And in fact, I would say there are downside risks to the forecast I have here. The Russian economy has been hobbled, of course, by economic fallout, including sanctions from the invasion of Ukraine. And Brazil did surprisingly well last year, but the outlook going forward is damped by interest rate hikes related to rising inflation and ongoing political turmoil related to the upcoming elections. So just for reference purposes, here's a table that summarizes the forecast that you can download with the presentation. But let me now dig in more deeply on the United States. So for the United States, the forecast is significantly less robust than what I was projecting last fall, and you can see that on this slide. And the basic story is that growth in GDP last year pushed the economy further beyond its short-run productive capacity than had been anticipated. So demand was picking up strongly, particularly once people were vaccinated, but the supply side was constrained by supply chain problems, as Chad will discuss, as well as worker shortages. But anyway, that's how we ended up with this very high inflation. And a key point is that underlying demand remains very strong at this point. So it will need to be restrained for inflation to moderate. To flesh out the story on demand, I have a couple of slides. So on this slide, I wanted to illustrate that consumers still have lost ground to make up. So here are a couple of important examples. Rising auto prices were a big part of the 2021 inflation story. And we are no means out of the woods yet. Supply remains constrained, we think. But even if it wasn't, there is a considerable shortfall in auto purchases relative to the pre-pandemic pace. So that needs to be made up. Likewise, as you can see on the right, people have been deferring healthcare services. I don't expect all foregone healthcare spending to be made up, but I think some of it will be. And there are a bunch of other high contact service categories where spending has further to go to rise to get back to a normal level. And then importantly, people have the wherewithal to finance this spending. So you can see the so-called excess savings. If you look at the aggregate saving rate, which is what I have on the left here, it's, by my calculation, it's amounting to more than $2 trillion at this point. And these excess saving, along with capital gains on stocks and home, they've led to a surge in household wealth, which has occurred across the income distribution. And that's what I'm showing on the right. So you can see the levels, of course, are very different for different categories, but it's a gain of about 20% in the lowest income quintile, and it goes all the way up to a gain of 41% in the top 1%. It is true that waning fiscal stimulus will offset some of the underlying demand after fiscal stimulus having been a boost earlier in the pandemic. And that's what I'm showing in this chart, with the drag on growth estimated to be a few percentage points this year. But do remember that the earlier increases in government spending and reductions in taxes, that is what helped people build their substantial cushion of savings that I showed earlier, and also contributed to many states and localities being flush with cash right now. So, the point being that the direct fiscal effects are negative, but there's still positive indirect effects from what's happened over the past 2 years. All in all, this situation means that demand will be and will need to be restrained by the removal of monetary accommodation. And this has become very clear in recent months. As you can see in the left on this graph, the projections from the March FOMC meeting included a substantial upgrade to the pace at which the Fed will be raising the funds rate. Communications from the Fed since then have clarified that the FOMC plans to begin running off the balance sheet in May, and also that they may need to raise rates faster than this. And you can see on the right, you can see that the pronounced rise in the 2-year rate in recent months is consistent with this, this changing belief that we're going to see a faster pace of tightening. So, whoops. In terms of, oops. All right. How much will the Fed tighten in terms of how much it will tighten? That will, of course, depend on how inflation evolves. So to remind people where we are, here is a graph showing that overall inflation began to ramp up last March. And has now surged to a level that has not been seen since the early 1980s. This is the PCE inflation measure. Based on what we saw in the CPI this morning, we should expect it to go up again when the data are released in a couple of weeks for March. But importantly, the gray line in the graph shows that measures that exclude the outsized changes. So measures like trimmed mean inflation, where you're taking out those categories like motor vehicles, where prices rose so sharply, they remained subdued through the end of last summer, but then began rising and have now also hit levels that have not been seen in decades. Models of inflation, they've really let us down over the past year in terms of forecast misses. But I still think that model logic is very helpful for understanding or for thinking about the evolution of inflation. So basically, models tell us that you can bucket the determinants of inflation into 3 categories. To start, there is slack, which is the extent to which demand is below or above potential supply. Slack is negative right now. There are supply shocks. So for example, if we're talking about reductions in Russian oil exports and COVID-related shutdowns in China, okay? And then the third bucket is the effects of expected future inflation and also the effects of past inflation on price setting behavior. So let me say a few words about those, each of these factors in turn. On slack, rising labor supply should increase slack this year. Not everyone is going to return to the labor force. For example, we've had an elevated pace of retirements, and some of those people may stay out permanently. But people are returning to the labor force, as you can see on the left panel here, as COVID fears ease and as pandemic savings run out. So we should expect that to continue to occur. On the right, much has been made in recent news about the flattening of kind of the foreign-born population that would be part of our labor supply. It flattened in the late 2010s after immigration restrictions were put in. But I want to point out that the situation is getting better. So you shouldn't take every data point on this graph too literally, because some of the month-to-month movements are statistical anomalies that should be actually smoothed over time. But you should take away that the gap relative to trend has really closed a bunch. It's closed from a peak of 2 million to about 750 million. So that's good news about slack, but at the same time, we should recognize that the labor market really isn't showing any signs of cooling yet. So I just want to point out, non-farm payroll employment, in particular, if you look at the 3-month moving average, it has been incredibly steady over the past year. And you can see also on the right that the job openings per unemployed worker is just at a stunningly high level. It's 50% higher than the level we saw in the robust labor market of the late 2010s. On supply shocks, my good colleagues, Stephen and Chad, will discuss them in a minute. So all I want to say with this slide is that some are maybe abating, but it's slow progress, and new ones are arising. And then finally, on expected future inflation and lagged inflation, which have this independent influence on the behavior of price setters. On the left, we should be reassured by the limited rise of long-term inflation expectations. My view is that people have been overly reassured by the fact that these expectations have remained subdued, but also that they are the dominant terms in models that are estimated over the last couple of decades, which is correct. But we need to recognize that those last couple of decades was a period when inflation was low and boring. I think the thing we should be worried about is that past inflation, which if you're thinking about models is captured by the inertia terms, is probably reasserting its role in shaping current inflation, given that people are noticing inflation much more these days now that it's so much higher. So just to illustrate that point, I'm showing you Google searches just showing that there's just been a ton of kind of focus on the level of inflation, which I think we all know is true anyway. So anyway, this all adds up to the idea that inflationary pressures remain really high and aren't likely to come down much by themselves. So the Fed will likely need to raise rates aggressively so as to tighten financial conditions, so as to restrain demand, so as to subdue inflation. Absent some exogenous tightening of financial conditions, I'm projecting a further increase in the Fed funds rate of 3 percentage points this year and another 50 basis points next year, such that the Fed's funds rate rises to over 4% by the middle of next year. As you can see on this graph in my projection, I kind of smooth the increases of the Fed funds rate in, but of course, they may occur unevenly over time. And as you can see on the right, I think this path of monetary policy is likely to reduce inflation gradually. So reduces inflation to core inflation to about 4% by the end of this year to 3% over the 4 quarters of next year. And this is consistent with a cooling labor market, with the unemployment rate rising in my forecast by the end of next year from around 3.5 percentage points now to 4.5 percentage points by the end of next year. It may not sound like much, but I'm also assuming that this is enough to cause worker shortages to dissipate. And just remember, it's not just slack that's pulling down inflation in this forecast, it's the tighter monetary policy, the bolder monetary policy moves, signaling that the Fed is serious, which then in turn keeps longer term inflation expectations contained. The last thing I want to say is that, this scenario, it's clearly a soft landing scenario. We should recognize that uncertainty is higher than usual, and I think the risks are to the downside. So among the things I worry about is that yet higher food and energy prices may result from war in Ukraine. We should be worried that inflation expectations will move up more than they already had, particularly in the absence of some better incoming data. So this morning's CPI release, I don't have it incorporated in this presentation, but there were, most of the news suggested kind of just no abatement of inflation, and in some categories, disturbingly higher inflation. So all of this could cause the Fed to tighten even more sharply than that I've penciled in, causing asset prices to fall sharply, consumers to pull back. And lastly, there are other risks beyond monetary policy. So risks abroad, such as potentially China's growth slowing down more than people expect. So all in all, I would put the odds of some combination of these factors pushing the economy into at least a mild recession by the end of this year at about 1/3. So on that note, I will turn things over to the next speaker.
Can I just say thank you, Karen, and just to remind our viewers, although I doubt you need it, we have been having quite an active debate among the macroeconomic team at Peterson over the inflation forecast, starting with a policy brief by David Reifschneider and David Wilcox, which makes the case in large part based on expectations for an even softer or even more likely to be soft landing than Karen does. And then, of course, pieces from Olivier Blanchard, Jason Furman arguing the other side, and Karen and Daniel each writing pieces in the middle. Plus, of course, our recent publications by Sherman Robinson, Karen Theofelder, and by Gary Huffbauer, Yuli Wang, and Meg Hogan on the potential inflation effects or disinfects if we were to liberalize trade. So this is a very important issue. I will just say before we turn to Chad and Stephen, which I think is a unique value add from the Peterson to this debate, I just want to reemphasize something Karen just said. As I said in the Global Economic Prospects a year ago, when I forecasted inflation was going to be higher than expected, it's essentially religion whether you decide to include the 1970s or not in your inflation expectations models. If you say we're in a different monetary regime and we've had 40 years of low inflation and therefore long-term inflation expectations are anchored, that gets you to a more benign scenario and you throw out the 70s. If, as Larry Summers or Olivier Blanchard, or to a lesser degree Jason Furman do, you say we are slipping a bit in regime, or because labor markets are so tight, the backwards looking updates on recent inflation, what Karen referred to, become dominant, then you throw the 70s into your regressions. And there's no way a priori to know which is right, at least not on a data basis. And so that, I think, is the nub or one of the key aspects of the inflation debate going forward. And I appreciate Karen setting out so clearly her balanced point of view. Let me now turn to Chad Bown, who has become of late the world's leading authority on supply chains from an economic point of view, just as previously he's been the leading authority on tariffs from an economic point of view. Chad.
Thanks, Adam. Let me also share my slides here. So I'm going to try to pick up where Karen left off, basically walking us through ultimately a more micro perspective, but I'm going to start off with some of the macro drivers, walk us through some of a particular example of autos and semiconductors to kind of put what's happened during the last couple of years into context, and then get into some of the details of some of the newer shocks that are affecting supply chains today with Russia sanctions and some of the Chinese COVID lockdowns as well. So just for context, and this sort of builds off of Karen's wonderful presentation, we did see with the pandemic this hugely negative shock to PCE and imports as well. And for goods and imports, things rebounded and rebounded strongly for all the reasons Karen articulated, but for services, it really didn't. And that meant a huge sort of expenditure switching away from services toward goods, which ultimately ended up stressing the logistics, transportation, infrastructure necessary to be able to get things to people. And that is, continued and hasn't really been abated. We do see pickups on services, but it's still below all the other categories and certainly pre-pandemic as well. These are a couple of charts from our friends at Flexport, and Flexport is they describe themselves as maybe the travel agency for container shipping. The one on the left uses some of their own internal data to track how many days it takes, say a container to get from a plant, say in China, to the destination port. So where it can be, sent on. So this is, think of, say the port of Long Beach, cleared customs, and then can be shipped off if you're thinking about some widgets that need to go into some production process in the United States. And as you can see, that has gone up tremendously over time, over 100% from pre-pandemic to end of last year. Things have slowly potentially started to decline early in this year, but it's a little bit early to tell because there's always some cyclicality in the sense of the early months of the Chinese data when they slow down for Lunar New Year. We're still waiting to see sort of what's happened in March and then obviously in April. The chart on the right is a new index that they've developed. It looks at just sort of the first stage of that process. So say within China, how long it takes to get from a plant to the Chinese port to then be sent off. And you can see there as well, things have gotten worse over time, but maybe abating. But again, this may not necessarily be good news. This could be symptomatic of some of the COVID-related lockdowns and restrictions. But in any case, this is just to show that there are these severe bottlenecks in the supply chain and the logistics side, which are impacting economic activity. The semiconductors and autos example is a critical one. I think this is probably familiar to most folks by now. The story is essentially when the pandemic hit, the automakers, which make up over 10% of consumption of semiconductors in any given year, broadly feared the recession and pulled their orders from semiconductor manufacturers, which were quickly replaced by new orders from all of the work from home, school from home, game from home, leisure from home demands for laptops, phones, servers, etc. And so when the automakers came back into the market in late 2020, there was just no capacity for them to have their semiconductors be manufactured, and they basically had to get at the end of the line. In terms of long run economic activity, this is just a plot, since the mid 1980s of the two sectors, semiconductors and automakers. And essentially they tend to move together in earlier recessions, but things are quite different this time around. And let me zoom in just in the most recent period here of the pandemic, and you can see this, a huge drop off in April of 2020 for the automobile sector in both capacity utilization and industrial production, but no drop off whatsoever in semiconductors, which saw that shift in demand from other end users. And as Karen, I think, showed in an alternative means, the auto sector, at least in the buying side, still hasn't picked up. And that's partly because the industry is still facing these supply chain bottlenecks, which are not allowing them to produce as much as they might want to. Two last slides on semiconductors. This is not all just the pandemic, though. We still have to remember there's still an ongoing trade war with China. Semiconductors were one of the early products that the last administration imposed 25% tariffs on. In volume terms, China is a huge, huge supplier of semiconductors to the United States. It was over 50% in, say, volume terms, number of chips. They don't produce the high-end stuff, but they produce a lot of the low-end stuff. And so when it only takes missing one semiconductor to be able to hold up, a production process, this can matter. And with the tariffs, imports from China went down. They weren't replaced by imports from other places, and they, still haven't necessarily come back. And of course, the tariffs are still in place. So to summarize the semiconductor and auto story, it was really a combination of factors. You did have the trade policy, you did have the switch in demand. I've characterized them as sort of earth, wind, and fire. But in addition to this, you had a number of one-off shocks. You do have in February of 2021, this freak Arctic storm hitting Texas, which knocked their power grid down for a month or so, or shutting down production for a number of automaker specific key suppliers to the auto sector. So Infineon and NXP are located there in Texas, knocked down for a month. The Renesas plant in Japan, another big supplier of semiconductor chips for the auto sector, had a fire in March of 2021. In any case, just the perfect storm of shocks have hit this sector and have impacted auto production, and not all entirely been fixed yet. Okay, my remaining couple of minutes, I want to talk about some of the new shocks that are confronting global supply chains. And obviously, as Adam indicated, we're now tracking sanctions here. And so this is a new website that we have put together and update almost daily on all of the sanctions globally that are getting imposed. But what we're seeing of this is a number of different channels through which this is likely to impact supply chains. And obviously, on a humanitarian basis, a very, very important one is food security. So Russia and Ukraine combined for something like 30% of global exports of products like wheat, which makes up 20% of human caloric intake. 30% of global exports are now at risk. And this is starting from a baseline at the end of 2021, where things were already not great. Stocks were at their lowest level since 2007, 2008, due to a combination of factors, high energy prices impacting fertilizer prices. That led major fertilizer producers and traders, including China and Russia last year, to impose export bans so they wouldn't ship fertilizers to other consumers around the world. We had a poor growing season for wheat, especially in the United States and in Canada. And so now when we add in today's problems of the war and additional countries imposing export restrictions, this has potentially severe consequences for global food security. Another channel through which sanctions could impact global supply chains. So with the Belt and Road Initiative, China has been, sort of building out a transport infrastructure to get its goods increasingly over rail to Europe. And so between 2016 and 2021, the share of China's goods trade with Europe had more than doubled, going through rail. And this could now be put at risk with the sanctions that are making it potentially illegal to be able to interact with Russian infrastructure, say. So this is something that we'll have to watch as well. Finally, as Karen had indicated, one of the newer concerns is the resurgence of COVID in China, which has led to pretty severe lockdowns in certain parts of the country. So just this year, the earliest one of these was in Guangdong province. And so this is down the Shenzhen region. And they huge share of China's exports. So, nearly a quarter of China's exports to the world come out of this, goods exports to the world come out of this one province. And so this is, a lot of telecom equipment, semiconductors, electronics. More recently, we have seen lockdowns, obviously, in Shanghai, a huge city, but also another 7% of China's exports, similar types of products there. And then over the last couple of weeks, also lockdowns in Jilin province, which is in the north, not a huge exporter, but a very rural and agricultural dominant region. So producing 6% of China's food and say 11% of China's corn. And while China's, in these types of products, not a huge global exporter, it is a huge global consumer. And so if there's not going to be enough food within China, that is going to affect supply chains in the other direction in terms of additional pressure on food prices and the like in response. So there's a lot of things that we're worried about and tracking closely from the sanctions front to the China and COVID front. And this is some ongoing work with my colleagues, Mary Lovely and Abby Dahlman, and something that we'll be keeping track of as well. Thanks.
Thank you, Chad. That was terrific. Your ability to cover so many topics. And just to say, again, as you mentioned, our colleagues, Mary Lovely, Abby Dublin, Tianlei Huang, Martin Charzemba, and Nick Lardy are also all at work trying to make sense of the downside risk to China. We may well have a separate event on that in coming days. I will just say that as reflected in Karen's numbers, we've downgraded our China outlook with a downside risk as Chad portrayed it. And I would just note that particularly under Nick and Mary's guidance, we have for the last several years been right versus consensus. When every time that people panic about China, we say, no, the floor is higher and more solid under Chinese growth. than you think. And in this case, us downgrading to consensus with downside risks is a significant move. So more on that to come, but just to say that that's, I think, worth noting beyond the supply chain substance of what Chad took us through. Again, I'm very fortunate to re-welcome Stephen Fries as a non-resident senior fellow at the Peterson Institute, as are we all. And it's wonderful to have you speaking to us today at this critical juncture, frankly, in world energy markets. Stephen.
Well, thanks so much, Adam. It's great to be part of the discussions today. So as Adam said, I'm going to build on Karen and Chad's remarks by taking a close look at the energy sector. And so let me just share a few slides on the energy aspects to the global outlook that Karen went through. So I'm briefly going to touch on 4 points. One is to begin just to characterize the state of global energy markets just prior to the Russian invasion of Ukraine, and make the point that not all energy markets are the same and that there are important differences amongst them. Then I'm going to take a look at some of the energy market dislocations that have occurred amidst the war, and also the bind between Europe and Russia on energy. Then touch on some energy market inevitabilities as a consequence of the war, and then look at some of the global implications for this. So let me just turn to the state of energy markets at the year. And the charts here show the level of real energy prices normalized to 2016. And we can see at the last figure in these charts is for January, and the level of real oil prices is high, but it's not quite as high as in real terms as they were in the first half of the last decade, or indeed just prior to the great financial crisis, or indeed if you were to go a bit further back in time to the 1980s. And so we have, by historical standards, a relatively moderate but significant oil price shock. Then what's a distinguishing feature of the current energy landscape is the fact that we also have, together with an oil price shock, also very significant shocks for thermal fuels, for natural gas and coal. And indeed, as we can see, that natural gas prices have reached in real terms a record level, an unprecedented high at the turn of the decade. And the tightness in natural gas markets has also pulled up the real price of coal. So let me just take a closer look at these two important primary energy markets. So for natural gas, we have record levels of what are called hub prices for natural gas in Europe and Asia, in the range of $20 to $30 per million BTU. And this is 2 to 3 times what could be considered a more normal level for these prices. And at the same time, we have North American natural gas prices that are double where they were just prior to the pandemic. And this tightness in natural gas markets is due to a combination of factors. One is the strong economic rebound from the COVID pandemic and the recession that it induced, combined with unseasonably cold winters in the Northern Hemisphere last year in 2020, 2021. And there were also some supply side factors at work on this part of the energy market. There were more than the usual level of outages, as well as a relatively low level of investment in capacity in the upstream supply of natural gas. And you can see some benchmarking done by the International Energy Agency in its most recent gas market report outlook, noting the relatively low levels of investment in upstream natural gas relative to what could be considered a business as usual, or indeed a net zero emission scenario through the 2030s. And so there has been a slowdown in investment on the supply side of the natural gas market. On the oil market, it was tight, but for a fundamentally different reason. You'll recall that in the midst of the pandemic, there were quite sharp production cuts by OPEC that were beginning to be tapered, that were eased in 2021 and then steadily progressed through the middle of last year and into this year, increasing output by around 400 million barrels per month. And at the same time, there was a steady recovery of non-OPEC supply. But the OPEC supply maintenance, together with the cooperation with Russia, was maintaining relatively tight market conditions that were leading to supply being somewhat less than demand and running off some of the sharp accumulation of inventories that were built up in 2020. And you can see those market dynamics in the right-hand slide. Now, let me turn to the energy market dislocations amidst the war. And of course, sharply on the heels of the Russian invasion of Ukraine, there were sweeping economic sanctions from the West imposed on Russia. Those financial sanctions, targeted in particular financial institutions, including the unprecedented sanctioning of the central bank, together with tech export bans and asset freezes for the elite within the Russian establishment, the political and elite and the oligarchs. But energy was largely excluded from these formal bans outside of the US and the UK, which have imposed sanctions on Russian energy. But the remarkable feature of the crisis so far is the extent to which the market has shunned particularly seaborne supplies of Russian oil, and the fact that Russian oil is increasingly being difficult, finding increasing challenges to be placed in international markets, and is trading at historically high levels of discount in the range of $30 to $35 a barrel. And so there is a lot of self-sanctioning within the market itself. And the other feature of the current landscape is the tight energy bind between Russia and Europe, both on the oil and on the natural gas side, which is why there's significant hesitancy there has been significant hesitancy on imposing stricter sanctions on Russian energy exports to Europe. And you can see this dependency on terms of oil on the left-hand side chart, with Russian oil imports into OECD Europe accounting for about 35% of total energy imports into total oil imports into Europe. And of course, on the right-hand side is the significant and increasing share of Russian natural gas and total EU and UK natural gas supply, and that the Russian share has been increasing as domestic supply within Europe has been declining with the maturation of the North Sea and the Dutch domestic production. So the Russian and European economies are quite tightly bound together by energy. Though it's important to recognize that oil is significantly more fungible than natural gas. It's much more readily transportable, and that there's, in a sense, an asymmetric vulnerability between Russian oil and EU natural gas. Russia is much more particularly heavily dependent on its receipts from oil exports, whereas the EU is much more tightly bound to Russia on natural gas. And the West has been seeking to shift away from Russian oil supplies by making overtures to OPEC. But OPEC is so far not shifted its planned tapering of its production quotas. And that reflects in part significant Saudi-Russian cooperation on oil. Saudi Arabia has been unable to stabilize the oil market on its own without Russian cooperation, and there's also a regional security dimension to this. And also the discussions with reviving the nuclear deal with Iran, which had been underway long before the Russian invasion of Ukraine, but those negotiations took on added meaning in the context of the current war. And we've also seen a significant increase in non-OPEC production, but this has been gradual, and there is potentially, and that underlying trend is likely to continue. Now, the one inevitability.
Just a warning on time, because we're going to have to questions.
Okay, so the inevitability from this is an inevitable shift from European demand away from Russian energy. And well, a range of options have been explored. In the short to medium term, this is likely to involve a significant greater call of European demand for global LNG. And that is likely to put maintain the significant tightness in global LNG markets. Now, the two implications of energy that I just want to touch on is the fact that the first is that the nature of the commodity shock, the energy shock, is quite different between oil and natural gas and electricity, and that Europe is likely to remain exposed to a significant drag, a significant natural gas and price shock that is likely to create a more enduring headwind to growth over the next year or two. But it's also likely to encourage a faster pivot away from natural gas and fossil fuels more generally to low carbon energy. And the one risk that I would like to highlight is around oil. The critical risks and the risks for market tightness are significant over the course of this year, but with the phased reduction of OPEC quotas over the latter part of this year and the ongoing trend increase in non-OPEC supply, the oil market is likely to become more evenly balanced towards the latter part of this year, and that the targeted releases from the US Strategic Petroleum Reserve would help see through the potential tightness in the middle part of the year. So let me just stop there and look forward to.
Thank you very much, Stephen.
Yeah.
Thank you very much. My apologies for interrupting.
No,
a number of good questions from online from the audience. I'm just going to go right in. Let me pair two for Chad first. From Paul Cho, could Chad comment on the impact of the major economies of East Asia, Taiwan and South Korea, manufacturing semiconductors on U.S. economic growth in the near future? And essentially, what's the longer term interconnectedness and path? And from Ed Brudswa, is there some debate on whether Section 301 or other tariffs have contributed to inflation, and whether tariff elimination or relief would help abate inflation? What is your view? So Chad, over to you, please.
Yeah, so I think just quickly on semiconductors, we've seen announcements from virtually all of the major manufacturers that they're undertaking significant, tens of billions of dollars of investment in additional capacity over the next 3 to 5 years. And we are seeing, industrial policy in the United States, in Europe, to encourage it as well. but and there's additional investment coming online in Taiwan and South Korea. So I don't see it as nothing negatively impacting growth. On the tariffs, I'll point you to a recent piece that my colleagues that I think Adam mentioned just published on this. Yeah, getting rid of the Section 301 tariffs could have an impact. I don't think any of us would say that it would be the panacea, but it could positively affect prices. That being said, it politically does not seem to have been taken up much at all by the current administration.
Thank you, Chad. Just to emphasize this last point, while none of us are pretending that trade liberalization is an ongoing change to inflation trends, as Gary and co-authors pointed out, and as Larry Summers in this discussion of their work pointed out, the magnitude that they're talking about, well in excess of 1%, perhaps as much as 2% on inflation, CPI, is an order of magnitude larger than many of the other things like price gouging effects or concentration effects on energy or meat markets. So this, and if we think that the economic damage and the political damage of inflation rises non-linearly, the higher inflation gets, the more damage it does a given unit. Taking 1.5% off or 1.2% off of Karen's mentioned 8% now is quite meaningful. Let me gather two questions for Stephen and then close with two questions for Karen. Stephen, so Nisha Patel raises the issue about nuclear power as one of the only ways for countries to bridge the gap and reach their net zero greenhouse gas commitments. Could you say a bit more about those prospects and also about the fact that so much uranium currently comes from Russia? Does that slow or impede the shift to nuclear if there was a political point of view? And then relatedly, sorry, I thought I had one more question for Stephen on the list. Well, let's just go with that for the moment, please, Stephen.
Yeah, so I agree with the point that nuclear power is an inevitable part of the solution for the low carbon transition, but it won't be a solution in every country. There will be countries with capabilities for handling nuclear power and its related infrastructure, but it will be necessary for stability of power grids in a number of different contexts. The supply of uranium, I don't think would be necessarily, Russia is a significant supplier, as is Kazakhstan, but there's a fairly reasonably well-diversified supply of uranium. And so I don't think supply on that aspect would be a significant constraint, at least in the foreseeable horizon. But also nuclear power operates on a very long horizon timescale for making a difference. And it won't play a role in the short run context that we were focusing on here today. Yeah.
Point well taken, Stephen. Just a very quick follow-up. The UK government made an announcement they were going to push ahead renewed on nuclear power. They made an announcement of that, I think, recently.
Yes.
When you say it's a long time scale, roughly speaking, if say the UK were to add 2 or 3 nuclear power plants, over what time frame do you think that becomes real?
Planning and building takes about 10 years to build a large-scale nuclear power plant, and the planning process adds a significant chunk of time onto that. So these are quite long horizon, but important components of the energy system. Yeah.
Thank you very much.
Yep.
Finally, to Karen, and again, my apologies to my colleague for the lightning round nature and to our guests that we're not getting to everyone's questions. This is great. Karen, 2 questions coming from Howard Schneider. Does this pace of Fed tightening that you're expecting and most of the market seems to be expecting for from zero to neutral seem like one of the fastest ones you've seen? I mean, leaving aside whether the Fed's behind the curve, is the pace of tightening something that you think is quite high? And second, you haven't really focused on issues of the impact of quantitative tightening or reversing quantitative easing or going from asset purchases to sales. How, in your view, does that figure in?
Yeah, so the forecast I've written down, it is faster than what most other people are projecting. I have the Fed tightening by an additional 3 percentage points by the end of this year. So it's about percentage point more, but I think the Fed may even need to go further than that. We'll have to see how inflation evolved. The quantitative tightening, what I've built into my forecast is about what the Fed has telegraphed so far, that it'll be about 95 billion per month. You know, I think the thing about quantitative tightening is that because the Fed has telegraphed it so well, you know, it's unclear we're going to see any effects when they actually deploy it. You know, that said, I think, you know, particularly when we think about quantitative tightening, we think of kind of these ultra low interest rates that are kind of, you know, affecting other countries that, you know, are maybe dealing with potential sovereign debt problems. My point in my presentation is we need a tightening of financial conditions. And kind of I built in this tightening that's induced by Fed monetary policy, but it's possible that we will see either changes in rates or changes in the balance sheet that induce kind of more of an effect on financial conditions than we think will happen. So kind of a good example would be kind of quantitative tightening leads to interest rates to rise in lower income countries that have high levels of sovereign debt, and therefore cause kind of a ripple of sovereign debt crises around the world that then disrupts markets, and we get this tightening of financial conditions. So yeah, that may be the case, in which case the Fed won't need to do as much work by raising interest rates, but it's still kind of the same story. We need that tightening of financial conditions.
Terrific. Thank you, Karen. Thank you, Stephen. Thank you, Chad. And thanks to our audience. Just a reminder that all of the presentations, slides, and the videos will be up shortly after the session ends on our website permanently, both for you to share with others and for you to check our forecasting record and issues raised in time for the next Global and Economic Perspectives in early October. With that, I'll look forward to seeing many of you at in-person PIIE Macro Week next week. And like all of you, watching how Karen, Stephen, and Chad's analyses spin out in the world that's spinning so fast. Thank you all very much.